Well, welcome back. We're going to kick it off with our next panel. This one's entitled Rethinking Insurer Investing, Strategies for a Changing World. As a reminder, we encourage you to submit questions through Slido, which we'll try to answer at the end of the session. So please join me in welcoming our moderator, Scott White, NAIC Secretary-Treasurer, and the Commissioner of the Virginia Bureau of Insurance. And he is joined by Jonathan Dixon, Secretary-General of the IIS, Vlad, Barbalat, Executive Vice President and Chief Investment Officer, Liberty Mutual, Eleanor Bucks, Chief Investment Officer, Lloyd's of London, Martha Leiper, Executive Vice President and Chief Investment Officer from Unum. So please join me in welcoming them.
All right, well, thank you, Gary, and that was a great first panel. It really was very informative, and we're going to hope to keep that going. So I'm pleased to have a great lineup of panelists here today. We've got Jonathan, Vlad, Eleanor, and Martha, and I look forward to our conversation. So, I'll start out by saying the obvious, which is that investing is at the heart of every insurance operation. It's a major focus of regulators. Insurance companies are some of the biggest players in the financial markets, whether you're talking about domestically or internationally. So we're going to have this group of panelists help us get a better understanding this morning of the nuances of insurance investing in what is obviously an ever-changing and fast-changing environment. What we're going to begin discussing is the immediate effects of the high interest rate, high inflation environment that we now face, and whether the environment we're in right now maybe has caused us to change some of our long-held assumptions. And then we're going to zoom back, if we have time, and focus on some related but broader issues in that respect. So why don't we just get started? And what we're going to start by doing is getting to know our panelists a little bit better, some of their backgrounds, particularly as it relates to their investment decisions that they oversee, or in the case of Jonathan, the major investing issues that the IAIS has been looking at. Well, let me start with you, Jonathan.
Okay, great. Well, hi everyone, and first of all, great to be here at what is really, I think, one of the premier get-togethers for supervisors each year. So great to be back. So let me talk a little bit about what the International Association of Insurance Supervisors do. So obviously, we're the global standard-setting body. So our job is really to complement the work that domestic supervisors are doing around insurance supervision with a global perspective. So one of our key activities is really putting a lot of effort into monitoring and assessing key developments and risks and trends in the global insurance sector, including on the investing side. And we do this in particular through an annual, what we call our global monitoring exercise, which actually collects data from over 90% of the global insurance market. So it gives us very, very rich data source. One thing I would flag around the investing side is that in common with our other standard setting bodies like the Basel Committee and IOSCO, we've certainly been considering the impact of high inflation and interest rates for some time, particularly on asset allocation and solvency, but also, I'd say, with added emphasis lately on liquidity risk and credit risks. And this has been part of our GMAR focus over the last 2 years. So we've been looking at the impact of rising inflation, rising interest rates, but also structural shifts in the life insurance sector and credit risks. And very happy to talk a bit more about that in the questions ahead, but just to essentially share that this is an active part of the IS's work at the moment.
Very much so. So I'll turn next to you, Vlad.
Sure. Vlad Barbalat, pleasure to be here. This is a first-time panelist in this particular forum, so thank you for having me. I am, as already been said, I'm the Chief Investment Officer for Liberty Mutual Group. Of course, we're one of the largest property and casualty insurers in the world, and we manage roughly $100 billion of assets on behalf of Liberty Mutual. ranging across all asset classes from traditional fixed income to alternative investments. And the team I oversee does everything from asset allocation, risk management, and of course, direct investing.
Great. Eleanor?
Super. I'm also really honoured to be here. It's great. I'm the Chief Investment Officer at Lloyd's of London, which we were sort of saying, and just saying, by the way, it's been around since 1688. I think we win, but anyway. If anyone wants to compete about that later, we can have a chat. But Lloyd's is, the oldest insurance marketplace. I work in the corporation. I think it's not as obvious to everyone what the corporation does. I think most people in the room will know what Lloyd's does. And the corporation, one of the insurers, I don't think it was Liberty, but one of the insurers who operates in the market.
We came a little after. Pretty old company, but not that.
But one of the insurers who operated in the market said really the role of the corporation is around managing the market and managing the central fund. And I think then in terms of what does that mean for my role as the CIO and what investment decisions I oversee, the marketplace has about $120 billion, I made sure I converted because I was thinking sterling in my head, of assets supporting all the business written in it. And more than half of that probably is US investment, because I think it may not be obvious to everybody in the room. People see Lloyd's as UK. Lloyd's knows very well that the business it writes is mostly in the US, or the business written through Lloyd's. And I get the best CIO job, no offense, that you could have, because I get to do actual CIO work. We run about $5 to $6 billion of central assets that mutualize and support the credit rating for all the business in Lloyd's, and that supports the policyholders ultimately. We also get to a sort of oversight role, really, in terms of setting the guardrails for what's appropriate investment in the marketplace. And the way I see my role is really about ensuring that the market is commercial, sustainable, and resilient. And so that informs how we think about setting those rules, so that there's not an undue strain on each other and on the credit rating as well. And ultimately, policyholders get paid. And then lastly, we effectively run a centralized global treasury service. So I run about $5 to $6 billion of global deposits from everywhere from Antigua to Zimbabwe. Run centralized FX for all the premiums and claims. And then what we're doing at the moment, which I'll talk about more when it's relevant, is developing a kind of a set of investment opportunity vehicles for investors or insurers in the Lloyd's market. So we're creating funds that enable participants in the Lloyd's market to access opportunities and create operational efficiencies, which I'm going to stop now, Martha.
Okay.
Martha.
Okay, hi, I'm Martha Leiper. I'm the Chief Investment Officer for Unum. 175th anniversary this year, so not as old as Lloyd's, but we've been around. Large disability, group benefit, voluntary benefit company based in Chattanooga, Tennessee. We've got about $45 billion of assets that we have invested. We invest them all internally. Very focused on asset liability matching. We have longer duration products, so 10 years plus, and no disintermediation risk. So this market has just been a fantastic market for us as we've seen interest rates come up and we can invest in higher rates. So.
Okay, great. Well, why don't we just dig in? So if you've been to the forum the last couple of years, you'll remember that the panels have really, at least part of the panels, focused on this theme around the low for long, low interest rate environment. We also had low inflation, but obviously we find ourselves in a different environment today, really a whole new world. So, we're going to dig into the specific issues, but I'm going to start off by asking you all to give kind of an overview of this new investing environment and what has changed and maybe what hasn't. So I'll start with you, Martha.
Like I said in my opening comments, this is a really good environment for us. It's nice to go to a conference where you're not talking about where are investors getting yield right now because interest rates were so low. And what we've seen is the ability to go up in quality and to go back to the more core and basic investment types. We're about 90 plus fixed income. A lot of that's concentrated on corporate bonds. It's been a good environment to get returns that fit the characteristics of our liability, in the regular market, not having to stretch for yield, not having to go down in quality or go into more alternative strategies to get that yield.
Okay, I'll go to you, Eleanor.
Yeah, I was thinking about this. There's probably in some ways more that hasn't changed than that has. But in terms of where I was thinking what has changed in a sort of structural way, maybe speaking to where you were thinking about, Jonathan, is the price of money. So money's been free for 15 years. And there's a lot of sectors that have grown up and their valuation models have grown up in that environment. So I think that's interesting, particularly in some of the tech sectors. That probably is a sort of a structural change. Rates volatility, I think it's come up already, it'll come up again. It's not so much the level as the volatility that feels unusual, because you sort of have government assets look a bit like risk assets, and that's, I think, quite interesting. I suspect not permanent, but interesting. Pace of movement of money, we all know about that, we've seen that. And maybe a broader macro point, but geopolitical risk feels like it is higher than it was, rather than it's a sort of an oscillation. I think the things, though, that haven't changed, so I was thinking the secular themes haven't changed around climate, for example. I think the shift from sort of public to private in the insurance sector, and increasing allocation of private assets and the use of private markets by corporations, I don't think that's changing. The importance of liquidity, which we've seen, has never changed, and it will always be a truism. It's the thing that matters in the end. And then the last thought I had is the rates, the deposits being paid by banks haven't changed. And I'm slightly exaggerating, they've changed a little, but they haven't changed a lot. And I think when we talk further about the impact of rates and inflation, to me that's a really important point. We talk about a high rate environment, consumers are getting, it rounds to zero on cash. So those are my initial thoughts.
Vlad.
Sure. I'll try to build on that. Lots of obviously similarities. I would say a couple of things. You mentioned that not so long ago we were talking about lower for longer. Now everyone wants to talk about higher for longer, but I just put that into the context of it's been about 18 months since the Fed went from a policy of easing at the fastest pace from the great financial crisis to actually hiking rates at the fastest pace in over 40 years. That's quite a U-turn for an institution that, I think generally tries to moderate the way it moves. And that's been dictated, of course, by the environment, which has been inflationary and I think has surprised just about everybody in terms of how sticky that inflation has been. In terms of things that have changed, therefore, I think you've already pointed that out. It has given us the opportunity to look at asset classes that were really challenged as asset classes prior to this rate cycle, and now they're back to being viable vehicles for return. What hasn't changed, I would say, is the intense focus on how we risk manage, how we think about even concepts of let's not extrapolate that today into the forever, because that's exactly what was being done 18 months ago. And so while interest rates are higher today, we don't exactly know, nor should we assume that this is the environment that we'll stay in for a prolonged period of time. Some of the challenges and the broader themes in the world are still very much with us, be that geopolitical issues, be it the deflationary and disruptive impact of technology, and relating that to banks. We can talk about that in a minute. So it remains a very dynamic environment, and it remains very unpredictable, as evidenced by the volatility of policy itself.
And Jonathan, what impacts on higher rates in particular has that had on the work of the IAIS?
Yeah, I was going to say, I think a bit of a shift in the supervisory focus around the investing activities. So we have seen this shift from low for long, which is generally positive for insurers and particularly life insurers. But I think there can be concerns or risks of dislocation that arise given the pace of that change in interest rates, and particularly, as I mentioned, possible liquidity risks. So, for instance, if insurers generally actually hedge against downside interest rate risk, if there's a sudden shift in that, they can be caught on the wrong side, and that might result in some liquidity risks if there's margin calls. So we're interested in that from our analysis. We talked about the low for long and how that sort of supported a shift towards alternative assets with some insurers, and we've particularly found it emphasized in those with a private equity link, utilizing investment strategies designed to capture excess yield from more illiquid, complex, or potentially volatile assets like private credit. And so we're very interested from a supervisory perspective in how that responds to what will be a much tighter macroeconomic environment going forward, and generally just credit risk, looking at the second round effects from the monetary policy tightening and what that could mean for sectors of the economy, the real estate market, of course, the commercial real estate market in particular, and private credit. And so I think these are part of what we're looking at. It's also, interestingly, part of what supervisors and policymakers at the Financial Stability Board level, which is looking at overall global financial stability, are interested in. Things like the potential vulnerabilities arising from hidden leverage, where you might have hidden leverage in the insurance sector as well, and some of these liquidity risk problems.
Excellent. Certainly like to keep our eye on and monitor when it comes to the high interest rate environment. Why don't we shift now to inflation, right? So what we've seen from inflation since 2020 is that it's been rapidly rising. It's still well above pre-pandemic levels. Obviously, inflation can have different types of impacts on insurers, whether it's our investments or on insurance products in terms of the claims themselves. So, Vlad, I'm going to start with you and ask, what impact has inflation had on your investing decisions at your company?
Sure. I mean, the primary, from an investing perspective, has been the impact on interest rates, right? And so we just chatted a little bit about that. I would say, look, inflation has had certainly a moment here, and one of the issues with inflation, the longer it takes to come back to an acceptable level, the more it gets ingrained and becomes more challenging to ultimately root out. And from an asset perspective, given, as I mentioned, we invest across the spectrum of assets, the impact to different asset classes is different. So some of the more kind of equity-oriented investments are obviously going to have the impact, as they are longer duration, from higher rates of bringing valuations down, particularly from really high levels that we experienced in 2021. On the other hand, this gives us an opportunity to reinvest capital into instruments that are offering us higher yield. It is giving us an opportunity to explore some alternative strategies that are offering yet higher yield again. And so it's inflation is at the core, but it's really expressed through interest rates, which is the foundational aspect of all financial assets. Of course, as you pointed out, on the other side of the balance sheet, inflation plays a lot of havoc with all insurers, but property and casualty insurers for sure, as we are trying to calibrate the rising costs. And of course, the auto market in particular has been one of the more dislocated sectors throughout the pandemic, with the demand for vehicles spiking, production being impacted by geopolitical issues and supply chain issues. And so that has all been a challenging moment. But like all these things, they tend to normalize. And so what we're observing with inflation is we're certainly making our way back down. We do believe that the Fed's response and ultimately getting interest rates to a positive real rate, which is where we roughly are today, is going to bring inflation to levels that are more in line with where we were. But the work to get inflation down from, say, 3% to 2% may be quite substantial and may take a lot of effort on behalf of the Fed, and that's something we have to be wary of.
Yes, for sure. Eleanor, anything to add?
Yeah, I mean, my views on rates and inflation, I kind of agree about the way those interact. I think my kind of prevailing thought is we sit here talking about a higher rate environment. We're on a running basis, most people are in a negative real yield environment at the moment. And so to the point you were making there, Vlad, it's in the US, it's just about even if you look at CPI print coming through and Fed rates. It's not at 2 months, it's not at 1 year. But it's just about the reality for consumers is that it's a negative real rate. That was kind of the point I was making around what the banks are paying. In the UK, even if you don't allow for that, it's sort of 5 to 6% running negative real rate. So for me, that makes inflation look quite sticky. And I think when you think about government Jefferson was saying earlier, which was really interesting, to listen to that, is how the consumer behavior is happening. The reality is, if you look at, Argentina, if someone who works for me from Zimbabwe, the reality of a negative real rate on consumer behavior is that the right decision is to buy stuff, not to keep money in a bank, not to save. So I think about that in terms of what it means macro. What do I think about what we then do as an investor? I'm going to do exactly the same thing. I'm buying stuff because I think inflation is sticky, and that's how you have value. And so what we're doing is actually increasing allocation to risk assets. And I think thinking around your point there, Jonathan, also private assets. Sorry, real assets, I meant not risk assets. The reason for that, when you're sitting where we are at Lloyd's, is we have nil exposure. Right? So and most of the investors within the market for the assets within the market also have nil exposure. So that's that's a particular point of reference. But because of that, that's what we're looking to do. So we see an opportunity. We're buying infrastructure, we're buying real estate, we're buying things that intrinsically have value, and that it has an inherent inflation resilience. So that's one thing that's directly to do with inflation. And then the other is, I'm trying really hard to resist the urge to hold cash as a risk-free choice, and I think there's a tendency to hug cash, and I think it's a slow death, in an inflationary environment. So those are my views.
So I think it's always helpful when we have these types of issues to maybe focus on a specific product to get a better understanding. So I'm going to turn to you, Martha, and maybe disability insurance might be a good example, and maybe how that's impacting policyholders.
I'd say from the product perspective, when we look at the employee benefits sector on the disability side, what we've seen is wage inflation. So people are getting higher premiums, which then translates, or they're paying higher premiums to us to invest because their wages have gone up, their employers are having to pay them more. We're seeing it as a benefit of more premium dollars coming in. So it's been a boost to the bottom line. What I will say also is what we've seen through the pandemic is people and the fight for talent that we've seen that employee benefit products have become a big selling point for employers. It's not just salary, it's what about my work-life balance? What about my benefit package? So from that perspective, it's been really good. But one of the other points, if I could, I wanted to bring in on the high inflation is, I think what you've seen throughout the industry is insurers going from an unrealized gain balance to an unrealized loss balance. And the negative IMR, I know, is a big topic that's being discussed in the industry right now, and liquidity comes into play too. As long as you don't have to liquidate those assets, you can withstand it. Most insurance companies asset liability manage, so I think we'll be in a good position.
Very good. And Jonathan, turning to the IAS, is inflation a factor in terms of any of the standards that have been developed or that you're developing currently?
Yeah, I mean, inflation and inflation risk is very much sort of ingrained in the insurance core principles that we develop at the IAS. It's core part of the risks that insurers play. So it's very much there in our insurance core principles, which is our global standards. Interestingly, as you know, we're also developing an insurance capital standard, a global insurance capital standard, which will apply to internationally active insurance groups, which is currently in a 5-year monitoring period. So, talking about this volatility of having gone from low to long to now rapid increases in interest rates, what we set out 4 years ago to have a 5-year monitoring period to see how the ICS is impacted through the business cycle. We've had a very good case study of that to help with the design of our ICS. We obviously, I mentioned already the work that we do on monitoring financial stability risks. We also do work to look at how trends are impacting on the prudential side. But the one other thing I wanted to mention in terms of concerns for supervisors in terms of risk to policyholders is, of course, how inflation is in many jurisdictions converting into a bit of a cost of living crisis. And what does that mean for policyholders? It means we are seeing increases in lapses and surrenders. It means we're seeing, I think, more pressures on some insurers, particularly probably on the P&C side. And when you have that, I think sort of conduct issues sort of shift up the supervisory agenda as well. So we're looking at work to, particularly around vulnerable consumers, and to see what we can do in terms of developing guidance for supervisors on how to respond to threats to vulnerable consumers in conditions like these.
Very good. So let's turn to a slightly different topic. You know, one of the big issues we've been looking at the NAIC, and it's one of our strategic priorities, is in the area of financial stability. And one of the focuses there is alternative investment or assets in response to the low interest rate environment, right, which we're all familiar with. But what effect have higher rates had on the desirability of alternative investment classes? So how is that shifting behavior? And for anyone who wants to take that. Martha?
Yeah, I'd love to start with that. Well, we have a small allocation to alternatives. It serves a very important part for our portfolio for a very long duration need. We want to get that equity type return. But what we're seeing now with interest rates going up, we demand a higher premium and a higher return expectation from the alternatives. So maybe less positive right now on the alternatives because I don't think they've adjusted up as quickly as the other assets. I will say, though, our approach has been a balanced approach. So we've seen several of the sectors perform very positively. On the direct lending, that's floating rate exposure. So we get a benefit of those yields go up as the underlying loans are paying higher rates, and real assets with inflation have adjusted upward. So we've seen a positive lift on those sectors of our alternative portfolio. On the equity side, a little bit of pressure right now as the equity markets have been very volatile and had a down year. But from our perspective, an additional piece that you can get from the equity portion of the investing is that ability to get maybe a more efficient source of innovation. You're getting to invest in funds that are innovative in the fintech space. You're getting exposure to those companies. So a much more efficient manner than doing that organically and trying to grow innovation. We're in such a highly regulated industry. Being able to see it happen up front and then partner with these companies and co-invest is very beneficial.
Thanks. I like what that last point you made, actually, because I was thinking something on this. I think it really does depend where you are. This is what it struck me as the technical aspect as much as the fundamental is really in play at the moment. So if you take private credit type assets, we're a cash buyer. We don't have any. I see a huge amount of opportunity there right now. Part of that opportunity is the fact that there's a lot of people who are technically offside, right? And so you see the higher rates. We've seen the impact that's having on banks. You know, the leveraged loan market is largely closed. A lot of institutional investors, because of the fact that public yields have moved ahead of private yields, you know, move faster, and there's a sort of gap compression, find themselves overweight and need to rebalance. Those are just structural pieces, but it makes an opportunity if you're not in that position. And that's resulting, particularly in direct lending, which we like, in attractive yields, strong covenants, strong LTVs. And I haven't seen a better entry since 2009. You know, we were really slow to the party, so I was kind of pleased there is one again. So, but to be clear, starting from a nil position, Lloyd's is, you know, most of the money within Lloyd's and the money we run is a core fixed income asset. So that's one side that I see. Definitely the point around floating rate, and then the other thing around innovation. Actually, the same thing in terms of opportunity there. There's a withdrawal of supply of financing to early stage tech. And I think there's definitely opportunity there. We're directly doing that in terms of investing in some of the Insurer tech coming out of our accelerator. There's the Lloyd's lab. People know about it. But I'm also thinking about that more broadly in fintech, in looking for opportunities.
Yeah, what I would add is, look, we've had a effort on the alternative side for quite some time. For example, we've been a private equity investor since the 80s, so we have a long tradition of looking at alternative asset classes. And kind of what I said before is don't extrapolate the current environment into the forever, or don't extrapolate the previous environment into the forever. So our approach is balanced. We are not changing the way we look at asset classes. We look at the relative value between them. And so there's certainly some shifts, as we've discussed and has been pointed out. On the credit side, you know, the industry tends to love labels, and so private credit tends to be the moniker of the day. But if you think about what private credit is, it's first and foremost credit. So it's not exactly revolutionary. It's just credit that is sourced differently, underwritten often directly. And in terms of even the liquidity profile, we often talk about, well, some of these alternative assets must be very, very liquid. They are directly negotiated, directly transacted. But if you have been in public markets long enough, you also know that some of the public markets that are liquid by name actually become very, very liquid if you were to actually need liquidity in a particular moment in time. And so when you think about liquidity, you better not be relying on your high yield bond portfolio to be the part of the portfolio that's going to offer you that liquidity in a time of difficulty. So completely agree on just the conceptually of how strong the opportunity set is in credit, period, be it public or private, and all the kind of events that have recently taken place across the regional banking system, I think only accelerate the need for alternative sources of capital to propagate credit through the economy.
Do you have anything to add, Malcolm?
I think just to add, it's been interesting listening to this because we had this alternative asset theme in our global monitoring exercise last year, and I think one of the questions was, with this turn in interest rates, will interest in these alternative assets die off? And there were question marks about that. I think it's clear this is not going away, which is good because actually with our global monitoring exercise this year, there's been efforts to refine that to actually enhance the monitoring of alternative investments and private placements. So a little bit later this year, we'll be able to say more about that, but it was interesting to hear that it's not a trend that's going away anytime soon.
Can I add? Sorry, just picking up on the point Vlad was making about liquidity, and it relates of public assets, public trade assets, relates to the point Martha was making earlier about the unrealized losses that all book value credit holders are sitting on right now, banks, insurers, and whether or not that's an issue will be very different from an ALM perspective for insurers than banks. But what I think it does mean is that structurally there's kind of an accounting inertia around selling assets that already had a lot less liquidity than people thought. And the US credit market it does have a lot of depth of liquidity. In the UK, you see it completely seizing up. And I think that point around the relative liquidity of public and private assets, it's probably getting closer, not further away. And I'd see that for a few years, until those books work their way through. And the other thought, that I meant to say on alternatives is private credit. When you were talking about that, as you said, it's just credit by sourced another way. It's also therefore covers a whole multitude of asset classes. And I think Martin and I both talked about direct lending. I have quite different views about commercial real estate lending, for example, than I have about direct lending. So we're quite nuanced and specific about where we see opportunities and where we think the opportunities are probably 12 months away rather than 1 month away.
Yeah, and just to pick up on that, and this will be our last question on this topic, and we've talked a little bit about it, but obviously higher interest rates and inflation have an impact on every part of the economy. You mentioned real estate. How has this investment environment impacted the sectors that you all traditionally invest in? And I'll just throw that out to anyone who wants to answer.
Sure. I mean, I could go in terms of sectors within the economy. Different sectors have different impact. The financial sector, we're obviously living the ramifications of such a drastic shift in interest rates within the banking system, and what havoc that has caused. I think there are other things at play though within other parts of the economy, and so you kind of have different industries very differently impacted. So the industrial infrastructure space tends to be still quite active in every single way, and that's really less of a function of interest rates and more of a function of the geopolitical tendencies and fiscal impulses that are rolling through the economy. So we tend to be quite nuanced as well, and try not to apply an overly blunt perspective on things. And there are parts of the private equity universe that are quite challenged on the startup and venture side. On the other hand, when you look at energy transition in infrastructure investments, the pace of activity and deal making there is as robust as ever, potentially. So I think different sectors are experiencing very, very differently.
And I'll pull up what Vlad talked about earlier about relative value. We've got pretty wide ranges within our strategic allocation that allow us to take tactical opportunities in the market. One area that we've stepped back for about the last 15 months is commercial real estate. As we saw the Fed start raising interest rates, cap rates weren't adjusting, and valuations weren't coming down to where we feel like they needed to. So we pulled back from investing in that area. I think that's been a good call. I think private credit, to your point, is getting very interesting, and real estate should, but we just aren't seeing that yet because the banks are stepping back from lending in real estate. And right now, a lot of transactions, if you don't have to go to market, you're not going to go to market. But eventually, loans have to be refinanced, new deals have to be made. So I'd say we're looking for where the opportunity is going to come.
I think from a sector perspective, stepping back for a minute away from alternatives, and I'll come back into that because I always get drawn into that conversation and it sounds like it's all we do. From a sector perspective, what I think broadly, I mean, if you across the Lloyd's market, which, like, you know, some of that's money Vlad's running, right? It's not all money we're running. About half of it's in cash and government bonds. So the thing that becomes really interesting, you know, is actually sector is quite a second order conversation. The first one is, did you go into credit at all? When it goes within credit, what you'll see, and I think you see substantially across non-life, you know, P&C insurers, is within that credit, because it is high quality, a high exposure to banks, right? And that's just a function of issuance. So, you know, half of the high quality short-dated credit is banks, depending on how you want to look at it. And so it's a function of issuance, it's a function of benchmarks. I've always been quite uncomfortable with benchmarks influencing your allocation, and it was in life insurance 2008, so, you know, I learned that the hard way, you know, and I know you don't have to be that influenced by benchmark allocations. So what I'm hoping to see from a credit perspective is a shift away from benchmarks and really focusing, you know, people who don't have the privilege of managing money themselves and are using fund managers, getting fund managers to work for their money, and thinking about the right risk sector allocations for them. So that's one, and then back into the alternative space, that sector differentiation. So we are, like, actively working with a cohort of insurers in the market to start investing in direct lending this year. We've developed a fund on the platform to do that. We're looking at real estate lending. I think that's a fantastic opportunity, and I don't think it's now, but I want to be ready for it, and the lead time is about 12 months. So looking at that, there, you know, you can see the opportunities there. I think it'll come through in about 12 months. So we want to get ready for that. But that's my.
Very good. So I want to spend the remainder of our time on some more topical issues, right? And we'll start with, and we have a question here that I think is a good one, the recent bank failures, right? And what impact has that had on the insurance industry? And what are the concerns and specific issues that you're monitoring? So I won't ask all of you, but just one of you want to take that up, and I'm going to have a separate question for you, Jonathan. So,
Well, I can start with that. So with the recent bank failures, it's interesting from our perspective. We've always been underweight banks and a lot of financial institutions because that risk can be binary, and didn't feel like you were getting paid for the risk for some of this paper that when it was offered, maybe an extra 10 or 15 basis points to go into subordinated paper when they're just deposits. So if a bank fails, it's usually a binary outcome. It's probably a low probability but extremely high severity. So when we dug down into what happened there, I think, you know, with Silicon Valley Bank, it was an asset liability mismatch. Couldn't get yield. There were no interest rates, especially in the short end of the curve. So a lot of firms went long, and it, I think, caught them. The other thing that we learned from that was just the power of technology now, because you don't have to go to the bank to get your money anymore. Somebody can tweet something, and then there's a run on the bank. So the quickness that happened, and then the spread through some of the regional banks was concerning. Really made us just focus on understanding where your exposure was, making sure the underlying underwriting was good, And then quickly looking throughout the portfolio to say, is this systemic? We believe it's fairly idiosyncratic, that there was more fear than fundamentals in the bank failures.
Anyone else?
Sure. I mean, I'd be happy to add. I think from a structural perspective, I do think the banking model is challenged. I mean, you talked about the fact that, you know, where you're being paid on deposits is effectively the same as that's the one thing that I think you said hasn't changed.
Yeah.
And that doesn't really make much sense. And when you put that together with the technology aspect, well, even going back to 2007, moving money around required a lot of friction. Today, I mean, you can move your money out of your deposits into a money market, earn an extra 5%. That's pretty easy to do. And that poses a fundamental challenge to the cost of goods sold to the bank. I do think the other important, so there's a question of the business model. And while that's important to point out, I think it's also fair to say banks are incredibly important part of the fabric of how the economy works. So just because the model is challenged doesn't mean, you know, you take that to the furthest possible conclusion. There'll be additional regulation, there'll be additional safeguards put in place, but certainly challenged. The other thing I would say is, I think when the Silicon Valley Bank failure kicked off, there was a lot of hysteria around, like, is this the repeat of the 2008 crisis? And while there was certainly a risk that there would be contagion to the banking system at large, a couple of observations. One is the tuition paid during the 2008 crisis by all our entities that were involved with that resulted in a very quick response, which was necessary and put kind of a firewall in place. The second is it has very different characteristics. This was a classic asset liability mismatch, kind of banking 101. This was not an issue where they had really bad assets on the balance sheet, et cetera, et cetera. It was just a very different animal. And so I think those comparisons weren't exactly accurate at the time. And then finally, I mentioned this before, because the tendency will be to pull back to deal with the issues of the day, regional banks and the banking system still remains the biggest propagator, originator of credit through the economy. And so when we talk about the need for credit to be part of the fabric of the economy, someone else is going to have to step in, and that's kind of where the whole private credit ecosystem, which again I think is just a big label for credit, the need for credit exists. The banks are going to pull back somewhat. Capital will find its way to that space.
So that's great, and you know that's the first question you asked. What's the impact on the industry with these insolvencies? But to me, the more interesting question, perhaps, is the lessons learned, right, from the recent turmoil in banking. What are the lessons that holds for the industry, and also are there any lessons that insurance can offer banking? And for that, I would turn to you, Jonathan.
Yeah, and I'd be interested to hear what others have to say. But just from the supervisory perspective, at the IIS level, doing a few things. So one is, I mentioned the risk monitoring. I mean, it's interesting what we've seen so far in our supervisory discussions is, with the exception of some idiosyncratic cases, the insurance sector has remained stable throughout this. We've also seen sort of direct exposures to banks from the insurance sector actually vary quite a lot across jurisdictions. So actually as high as 35% at the top end, but most significantly below that actually. So actually I think the attention is probably more on the second order effects that we discussed. In terms of, I guess supervisory lessons, I think nothing that would be new to the insurance sector. So the importance of good asset liability management, the importance of managing your leverage and not having excessive leverage. I mean, we obviously when these things happen, there are questions asked. What does this mean for the insurance sector, or what are the insurance sector vulnerabilities? So we spend time talking at these FSB levels about the important differences in insurers' balance sheets compared to banks, and and the different nature of insurance contracts relative to the banking deposits. But having said that, there are still residual questions. So we had the LDI event in the UK, which led to questions around even institutions with long-term liabilities could be exposed to liquidity risks. What does it mean for the insurance sector? We also, of course, take an activities-based approach to looking at vulnerabilities in the insurance sector. So if there are entities which have business models or products that start to approach banking deposits or banking type models, we alert to vulnerabilities there, particularly because I think another interesting lesson from the recent events was the sort of the extreme nature of some of these movements, and the speed of the movements because of the influence of social media and so on. So if there are products or business models in insurers that approach banking deposits, could they be exposed to the same liquidity risks? So these are the things that we would be looking at. I mean, more generally, lessons from the insurance sector to the banking sector from the supervisory perspective. I do think it's interesting that I would say generally insurance regulations tend to be more forward-looking and on the capital side as well. So a lot more sort of stress test-based capital requirements and so on, and banking a little bit more backward-looking. So maybe there's a lesson there for the banking supervisors.
That's a good observation.
Commissioner,
Go
could I
ahead.
add just one thing on that? I'm not going to repeat what you guys say because you covered it all. But on the second order and liquidity point, I think the one thing, we're resilient. The industry is resilient to it for the reasons you've said, because actuaries are great. But the other thing, there is the second order impact we saw, which I think can be addressed. But if you saw a wholesale downgrade of the banking sector, is the reduction in available collateral. So a considerable portion of all NAIC 1 assets are bank credits, and they're all within 2 or 3 notches of moving out of being NAIC 1. So that's something that we think is quite interesting in terms of where you could see an impact. Do I think there'll be a wholesale downgrade at the same time? Not necessarily, but I'd like to know what would happen if there was. So that was it.
Very good. So another development in investing that's been getting a lot more focus is in the area of environmental, social, and governance impact of investing decisions. Something we're looking at the NAIC and have gotten a lot of more discussion about. There are obviously a variety of ways to approach this. And let me ask you all about the importance of ESG to your own organizations, and then maybe mention a few examples of work in this area. So who wants to go first on this one? I'll go with you, Eleanor. You look like you
Because
want.
I keep speaking, so I was trying to be quiet.
That's fine.
So I love talking about this one. I mean, Lloyd's sort of set out its stalls talking about what they think being the insurer transition means, and working with companies to, and the broader economy to support it through that journey. From an investment perspective, I've been working on this a lot for the last, since I got into the job, and we actually a few weeks to months ago, launched the first fund as part of the Lloyd's investment platform that I was talking about. And it's a private impact fund. So what we've been doing is thinking, right, this is a structural theme, right? As investors, there's a structural theme here around climate. What's the investment opportunity, and how do we address that theme to achieve a return and achieve an impact? And we thought, let's make this be a flagship thing, and let's start there. So we've created a fund. We've got $250 million allocated to it already for anyone in the market to invest in. But what it's doing is saying there are real areas of investment that is required that are currently undersupplied by capital. What are they? Climate adaptation. We're going to be 1.5 degrees of industrial levels. I think they came out this week, before 2027 and possibly this year for the first time, right? So it's a known. It's not really one that's being invested. And I think actually when the NAIC president, I think I was talking earlier, you were talking about that, which is there's a whole bunch there about resilience and infrastructure that can be addressed that actually capital isn't addressing, really. It's mostly focused on mitigation. So we're looking at that theme. We're looking at global dispersion. There's a lot more concentration of capital flowing into Europe in this area than there is globally, and I mean both in developed and developing countries. So the fund is really targeting that as a substantial weighting to the US, but also to emerging economies. And seeing what are the themes that are going to play. So it's climate adaptation, climate mitigation, but also social inclusion and natural resources. And we're generating return because we're doing that in a really economy supportive way. Saying what are the corporations that are going to benefit? What are the, in private equity, which companies are promoting circular economy? They've got good recycling of resources, they're creating recycling of resources in supply chain. Those companies, will boost economic growth, we can benefit from that, but really they will succeed and they will be a part of generating that change. So we've created a European regulation, but Article 9 fund, that's a disclosure point, but it really means that every asset has a targeted ESG objective that is measured as well as a financial one. And that's around ensuring that we hold ourselves to the highest possible standard and that it can't expose us to greenwashing. So it's positive ESG action. And it's just really exciting. So we're thrilled.
Yeah, I comment on a few of those things. I do think it's important that you get into investments that are providing capital to companies that are going to be on the front of transition, because if they don't have capital, they cannot transition and get to a better place. So I think that's very important. I also think getting it in a manner that provides return for your policyholders, because that's a fiduciary responsibility that we have to generate a return. That's important. We've long factored in ESG characteristics in our analysis because we feel like companies that are run better, that are positioning for the future, are those that are going to be around for the long haul, that are going to be better returns. So it's not a new concept. I think what's newer to us in the US especially is just the documentation behind it to be able to show. And then the other factor that I'll tell you that is concerning is just what a political issue this is. And you have to be careful that you're making the right kind of change happen over time, but you're navigating through this environment of a real interesting political state where some of our states kind of want to penalize you for having ESG policies and others are demanding that you have them. So there's a lot that needs to play out here.
Yeah, I mean, a lot's been said. I would just, going all the way to the top, I think there are few industries that are as aligned with the concept of a stable climate and sustainability as the insurance industry broadly. I mean, it is very much inherent to our business, and therefore, I think everything we want to do is in that direction. I would just say from a perspective of the way we think about our investment process and how we do our investing, we've never taken an exclusionary view of how of assets or walking away from a conversation where you have a challenged asset that needs to transition. I think you made this point. If you pull the capital, if you walk away from the table, other actors will step in, and they're not likely to be as responsible of actors as we may be. And so we think about sustainability and all issues around that very much across the investment process holistically, without necessarily swinging too far to one side or another for reasons as already stated, but that's actually just a side component to it. We just fundamentally are in the business of having our capital be a force for good, and at the same time be focused on returns, which is our primary responsibility.
Right. Anything to add, Jonathan?
Yeah, just to say from the IIS side and amongst the global supervisory community, I think ESG issues are very front and center as well. So obviously on climate-related risks and the importance of that for the insurance sector explains why it's a priority for us, and we've done a lot of work on that across. I mean, there are probably few areas where we have a degree of consensus on the need for action that we do on climate issues. So this is very much, I would say, probably the top priority for us at the moment. I mean, the work includes, as I mentioned, the work that we do on a sort of risk assessment side. So our global monitoring exercise over recent years has done some interesting work to collect data from this very broad global insurance sector database that we have on exposures, both on the asset and the liability side. The work on the asset exposures is a bit more advanced, and we put out an interesting report on that last year, which looked at insurance sector exposures to climate sensitive sectors in different jurisdictions. So we'll continue that work, because I think having the right data on these issues is a big part of having a good response. The other part of our work is working with our members to develop supervisory guidance, really guidance on what supervisors should be doing to encourage insurers to be taking the action they need to be making. Luckily, I agree, not that much encouragement needed, because I think most insurers are being very responsible about this, but this helps to ensure a level playing field, and also helps across our broad membership, which includes 60% of our 200-odd members are from emerging and developing economies, where that guidance is also very helpful. I would just briefly say we're also doing work on the S part of the ESG. So financial inclusion has been a priority topic for us for over a decade, and more recently, diversity, equity, and inclusion imperatives. And we put out a very strong statement, I think, from a supervisory perspective on the importance of D&I in the insurance sector to drive better outcomes, better decisions, which I would say probably includes better investment decisions as well.
Excellent. So I wanted to pick up on a topic that was discussed very well in our first panel, and that's artificial intelligence. And there was even some discussion about the recent advances for ChatGPT. And I wanted to know if anybody on the panel has any thoughts on what impact artificial intelligence might be on insurance companies' investment decisions. So anybody want to tackle that question?
Sure.
Vlad?
I could start. I guess I'll actually loop it back to the question of inflation. And so when we think about the drivers of inflation and the drivers of disinflation that were so prominent pre-pandemic, I would say AI is a manifestation of technology that's happening faster than ever and improving faster than ever, that is quite deflationary. And so in the context of the inflation issues, I think this is a very beneficial thing. Now, when technology moves very, very fast, it can be disruptive, and it's a question of how institutions are able to absorb it, how society is able to absorb it. But I do think this is certainly a moment that is very, very relevant, both for the way the insurance industry operates, any industry operates, and the way investment decisions are ultimately made. So besides the obvious of being exposed to companies that are in this space, I would say investment decisions are always, in the end of the day, taking some information and making judgment with what to do with that information. The speed and the accuracy of how that information may arrive at a decision maker's desk, that's going to improve. Is AI going to take away the human? I don't think so, and I would just say, I wasn't there, but I'm pretty sure when the wheel got invented, somebody was complaining about the fact that their legs would no longer be used, and so, tools and technology is tools. Tools have been around as long as humans have been around, and humans just simply elevate what we focus on, and this will be no different.
Yeah, I mean, I'm not going to disagree with any of that. But I think there is that disruption point. I think there'll be winners and losers. So I think it will, in terms of just purely in terms of which assets you're investing in, which companies you're investing in, judgment on that I think will be more important. There's been a high tide raises lifts all boats in terms of the asset price inflation we've seen for the last sort of 15 years. So I think that is one of it. I do think that fund managers could be displaced by it. Just put that out there, because actually what AAA does really well, and I'm not a computer science major, I'm a physicist, but anyway, what it does really well is analyze really quickly and interpret patterns of information it can see, that can be observed. That's not the same as telling the future, right? But actually, fund management, a lot of that is a really intrinsic understanding of how the other actors are going to behave. So I can see a kind of algorithmic trading 2.0, with AI potentially happening. I definitely think that's true particularly on the private credit side. You can see AI helping you underwrite. I don't think it replaces the person. But the other thing I think is actually that's a big change, right? There's big change that we haven't yet seen yet, like blockchain. There is clearly big change from an investment asset management perspective that hasn't yet manifested, which I think will come first. And that's just the way we administer assets and transfer them globally and record keep on them. the way we do it now will be seen as so antiquated in 3 or 4 years' time. That's all Excel and, you know, like we see Excel and macro. I think that will all be, those records will be held on blockchain. I think international regulators, whilst everyone's here, you know, all recognizing that as a more secure means of identifying assets can have huge benefits for actually the global resilience of the system, you know, because of the ability to understand who holds what, to move it quickly. And so for me, I think that has to come first. And I know some regulators are working on it, but I want to see that happen in the next 1 to 2 years as well.
I think that's a great point. Martha?
I was just going to say, I think the way that we analyze the data and can make decisions, you can give people more power. You can hopefully be able to see trends as you're just getting information and access so much quicker. I think it will get into how assets eventually are priced and moved, and there's going to be a lot that's developed. I don't know that I really know what all the change is going to be, except it's very disruptive and we need to stay ahead.
Okay, we are running out of time. We do have an interesting question that I'm going to ask, and whoever wants to answer this. So what the question is, are insurance companies considering the potential impact of a U.S. government default, and are international entities considering this as well? So who wants to tackle that one?
I can tell you we spend a lot of time on this because I think it's a very low probability but very high severity. It seems like we've been in this situation in 2011, 2013. At the 11th hour, a decision gets made. At some point, maybe we slide and we let the government either prioritize payments or default. I think that has really big repercussions throughout our economy and internationally. And I don't think right now that's appreciated as much. So we spent a whole lot of time on stress testing for what if this happens, looking at our liquidity waterfalls, just trying to assess how we can respond if that happens. It could get into derivatives and collateral posting, and it just is going to have some pretty significant tentacles.
If anyone doesn't answer yes to that question, I think we should be a little embarrassed. So, but yeah, we're thinking about it. The other thing I'd say is it speaks to the earlier point I made, which is treasuries feel a lot more like a risk asset than they should do at the moment, that, you know, with that and rates volatility. So I think that's definitely the case. And I had another point to make that I can't remember now. So let Vlad answer.
I would just add, look, I think everyone's going through a variety of different tests and et cetera, but I would just put it as, in the end of the day, all these scenarios that you try to paint around this, it's kind of like telling you that, you know what, you've got to plan for a scenario tomorrow where gravity will be removed. It's a little bit difficult to imagine exactly what would happen. And I think this is very much in that realm. You know, treasuries are at the core of everything and how investments are priced, moved, collateral. So if that is no longer a risk-free asset, it's nearly impossible to understand the repercussions on the system.
Yeah. I know what I was going to say. I don't know which year it was, but it happened over Christmas once, and it ruined my Christmas, New Year's. I had to spend the whole time hedging, adjusting hedge positions. So I'm really grateful it's not Christmas. That's about all I can say about it.
Any thoughts, Jonathan?
I probably won't comment specifically on this, but what I would say is that we spent time talking about credit risk and private credit and so on, but the other area that we are looking at carefully is sovereign risk, because you know, if we look across the globe, and the World Bank, IMF have done a fair bit of work on this. The stressed fiscal positions of a number of governments in different regions. So, and of course, in some regulatory capital approaches, the sovereign debt does have a zero risk weight, but in reality, there's not a zero probability of defaults on some of these sovereign debt. So that's an issue we're looking at.
My hope is that we are not having a panel discussion next year with you all about dealing how we've dealt with the fallout from the government.
I think we'll all be
default.
fired if that happens.
So I think that's all we have time for, and I want to thank you all for what's been, to me, a very fascinating and engaging discussion. And why don't we give a round of applause to our panelists.